Good morning, afternoon, or evening to everybody, depending on what time you're watching this. So today we're going to do something a bit different. We're going to do a weekly review of the price action on USD JPY. The reason I'm putting this video up is because it touches a bit on the last video I did on the points of interest, the supply and demand areas, and also the fair value gaps. Yes. So the reason I'm doing this is because I was doing my weekly review like I do every weekend on USD JPY, and I realized that okay, the way price moved this week was a perfect example of how to use supply and demand areas and also fair value gaps. So I thought, okay, it would be a good idea to make this video and put it up so that you can see how to actually put your entries and use those points of interest to enter trades and exit them. So let's begin. Going to the daily time frame. Actually, this was what I saw. Going to the daily time frame, we can see where price is anyways. When price was here, I was targeting this high and it got taken. So normally, unless something happens, I would expect price to push up all the way to this high, but as we can see, price reached, let me mark it out. As we can see, price reached this order block right here. Now, some may say this is not an order block because it did not give a market structure shift, but this being the daily time frame, for it to have sponsored such a strong move downwards, it's definitely a valid order block, a valid supply area. So because it's such a high time frame, it doesn't really need to give a market structure shift. So yes, this order block right here. So now looking at this, let me mark out the beginning of the week. Oh, let me just mark it out like this. Yeah. Oh, sorry, my fault. Horizon. Okay, vertical then. So yes, looking at this now, we can see price reach this area. Of course, even as it reaches this area, it might not hold, but I am giving it stronger consideration because it is on the daily time frame. So now looking at this, I'm still bullish unless we get confirmation that says otherwise. So now you can see this right here. So I go to the 30-minute time frame. Yes, so right here. Yes, we can see. Okay, so what I would be looking at here, really I would just be looking for a market structure shift, and as we can see right here, sorry, right here, firstly we got a liquidity sweep. We haven't talked about that yet, but we got a liquidity sweep, and then what happened right here, we can see right here we got our market structure shift. So let me write it down right here. Market structure shift, MSS, right here we got our market structure shift. So now what do? We start looking for sells, and what sponsored that market structure shift? We can see this right here, it's from here that price pushed down and gave that market structure shift. So what we do now, we mark out, because that's a supply area now, because it sponsored a market structure shift. It's an order block, it sponsored this market structure shift right here. So what we do, we place our sell entry right here, and what you do, you cover the high. In this case, since it's a bearish order block, a selling order block, you cover the high. You make sure your stop loss covers the high and give it a little bit of room, just in case. And then seeing as someone like me now, most times I'm not going to say, okay, I'll hold the trade all the way down here just because there's a low here. I like to target what I call low hanging fruit, very achievable targets, where you'll be in and out, no stress, peace of mind and all that stuff. So for me, I would have probably just looked for, maybe 4R right here. Yeah, as I was saying, right, I would have looked for, something like let's say 4.5R right there. That would have been my exit on the trade. So as we can see, price gave the market structure shift, came back to the order block that sponsored the market structure shift, and what did it do? It delivered a very clean price action, right? Right. Okay, so looking at this now, my next entry was right here. So I'll explain it. I'll explain it right here. So firstly, let me zoom in. What can we see right here now? We can clearly see, you see there's this first candle here, and then this second candle, and this third candle. We have a fair value gap right here. Let me remove this. We have a fair value gap right here. We can see the bottom wick of this first candle and the top wick of this third candle, right? Top wick of this third candle, there is a gap in between them. Very clear fair value gap, right? It's very valid fair value gap as well. So that would be where I would enter, right? But also, to be on the safe side, I would like to cover this area like this when I'm entering the trade, because price might decide not to use the fair value gap and to just overextend a little bit and tap this order block. So I would have my stop loss right above there, my entry there. So, and here I would definitely target these lows because I think it would be achievable, and I would target just a bit after for risk to reward. So we can clearly see right here, price came, tap this fair value gap. Like I said, we cover this order block here with our stop loss, so that if price decides to overextend just a little bit, we won't be stopped out. So you can see price gave very good delivery here, right? Also, when I'm on trades like this, I like to get re-entries while market is still moving, right? So let's say now, for example, let's say, for example, yes, sorry, for example now, this right here. Well, let me mark it out with a zone tool. This right here. We can see right here, it is also a fair value gap, if I'm not mistaken, right? We can see this first candle here, second candle, third candle. So the bottom wick of the first candle and the top wick of the third candle, there's a very clear gap in between them, right? Very clear gap in between them. So, and there's nothing really like an order block that I would expect that could draw price back upwards, right? So I would definitely add a position there too, and my stop loss would probably be up here, and then I would have the same target still that I'm targeting, because this is just a re-entry on the same trade. I'm just adding positions. So, and right here again we have another fair value gap. I will mark it out, close one too as well. When it's not my main trade, I just prefer to mark it out with a line tool, because keeps my screen less messy. But for clear understanding, you can see again here, right? Bottom wick of the first candle, top wick of the third candle, they leave a gap, a sizable gap actually. So you see, I would re-enter positions there again as well. And for this one, sorry, and for this one, you could have, it's risky having your stop loss here. Me personally, I would have it either here or even above this candle right here. That's where my stop loss would be. And now let me this is I've been wanting to talk about this, so let me talk about it now. So as we can see here, in this very area, here, right, we have two fair value gaps, because we can see here 1, 2, 3 candles, and the bottom wick of the first candle and the top wick of the third candle, they do not touch. So they left a gap, right? But then also we can see right here a fair value gap right after it as well, the bottom wick of the first candle and the top wick of the third candle, they don't touch, so they left a gap. Now me, like, I would have entered right here, I wouldn't have used this fair value gap, and someone might ask why not, right? So basically, this is from what I've personally learned from trading fair value gaps. When there are two consecutive fair value gaps, usually the situation itself becomes the fair value gaps anyways, if they're retraced back into, usually they are lower probability, both of them. But if you do want to enter, it'd be better to enter off the original fair value gap, the first one in the sequence, because the second one is definitely low probability. Whether it's second, third, or whatever, is low probability. Now let's say something like this instead, where you have a fair value gap, and then let's say this was not retraced into, you have a fair value gap, and then you have this, these candles here before you get another fair value gap, then you can comfortably enter on the second fair value gap. But when you have both of the gaps right here, you have both of them, when you have both of the gaps consecutively, right, you should avoid the second one. If price comes back into, you should avoid it. It's low probability. Don't get me wrong, there are situations where it does play out, but those situations are a lot rarer than, so I think it's best to avoid that. So I would have entered another position right here, and my stop loss would have been right here above this candle, right, and I'm safe. And price, like, anyways. So now let's zoom out real quick, so we can see those are two clean trades. This second one had multiple re-entries as well, right. So now this actually, as if we can see, this is also an order block. The way I did it when I was trading it this week, what I did, I marked it out this way completely. So we can see this itself is an order block, but I marked out the whole thing in case price decides to overextend and reach this, extreme order block right here, right. So the way I entered it was, I just put my sell tool here, and then my stop loss above that extreme order block, and then of course, as you can see, I targeted these lows right here, right. So now, at first it was a bit choppy, went to entry, moved a bit, came back to entry, but as we can see, once it started moving, it gave a fair value gap. That's another entry right there, right. As you can see, there's no consecutive fair value gaps before this one. So price came back into it. That's where you add your position, and to be safe, I would have my stop loss up here, because so, and then as we can see again, as price did this, it left another fair value gap right here again. See, price came back to it, tapped it, kept moving. Definitely your stop loss would be right there, right. And then you see price moved again. I wouldn't really call this one a fair value gap. I feel like, I don't know, it's not a valid fair value gap, but this right here is a valid fair value gap. But even so, if you're entering on this one, I would recommend still having your stop loss somewhere up here to be on the safe side, right. So yeah, so usually when I'm already in a trade, if I'm adding positions, re-entries, I prefer doing it off fair value gaps mostly. I don't really like entering off, order blocks for a re-entry on a trade I'm already in. But like for the origin of the trade, yes, order blocks are good. And don't get me wrong, even as re-entries, they do play out. But personally, like my personal preference, I prefer having, fair value gap re-entries. And see what I said here? Like I said, have your stop loss up here, because if you had it just above this fair value gap right here, you see market will have taken you out. But you see, having it up here, you're still safe. This is just market experience here. So as we can see, price continued and reached its target, right. So now we can see it's from here. Let me extend this to show it. So we can see price reached target here, right? So now looking at this structure, what I would mark out first, like let's say after price reached target, what I would mark out first is this big fair value gap here. Usually with these bigger fair value gaps, I like to use this fib retracement tool. If you're using yours, it might look different. This is just how I have mine set up, just these three lines, very simple: 0%, 50%, and 100%. So with bigger fair value gaps, I like to use this fib tool and enter at the 50% of it. It's just for risk to reward reasons, so that I can have a better risk to reward. It's not really anything special. I just use it to have a better risk to reward, right. But as we can see, as market moved, it didn't retrace right back into it, right? What did it do? It gave another fair value gap, right? And definitely this line right here is my eventual target. So as we're getting fair value gaps, I would mark this out right here, because as we can see, this and this, they are not consecutive, because there's this candle right here in between them. It's not like we got this fair value gap and then we got this one right under it. No, so they're not consecutive. So price can definitely still play out of this one, right? So as I see this, that's what I'm marking out, right. And then as we can see right here, let me mark this out. As we can see right here, there's a second fair value gap there. It becomes a consecutive fair value gap. And what did we say about those? They are not what you want to trade off of. You wait for price to come back to this one, right? And that happened. Price came back to the fair value gap. This is how I do it. Have my stop loss right there, and then my target here. So as we can see, what happened here, price moved all the way to what price gave us 4.3 R, basically 4.3 risk to reward, before eventually reversing and taking us out right there, right? But it gave a very strong move before reversing from this fair value gap. Like I said, we avoid this one. So now the current structure, price has returned to this original fair value gap that was untapped. It got to the 50% and it is currently selling off, sorry. So now looking at this very structure, what I think is going to happen next, I think we're still selling unless we invalidate this fair value gap. So if we get a close above this line right here, if we get a close above this line, then I believe we've probably switched to bullish. But I think definitely as long as this fair value gap doesn't get invalidated, we are still bearish, and I expect us to reach this target that I have marked out, because it was my long-term target last week. So as we can see right here, there's actually a fair value gap. What's going on? Okay, yes, as I was saying, as we can see, there's actually a fair value gap right here, right? And it was created off of this 30-minute fair value gap. We got another one. So looking at this current structure, what I would do, of course, I would place my selling tool right there, but my stop loss would be above this right here to be on the safe side, because definitely the way it's looking, market could very likely decide to tap on this before moving, because it looks like it's building liquidity, or maybe it was just slow because this was towards market close last week. So anyways, we'll see how and what it decides to do eventually, but I do hope this video really helps you understand how to trade using fair value gaps and order blocks, which are the points of interest I talked about in the part 1 of the points of interest video. And hopefully sometime this week I will have the part 2 of that video out, although it definitely won't be as long as the first video because there isn't as much to talk about when it comes to key levels and highs and lows. Definitely with highs and lows, especially because yes. But I do hope this video really helps you, and thank you very much for watching. Goodbye.